Hello, this is Steve Sanangelo once again from the SRS Rocker Report. And I'm very glad that you're joining me today because I'm finally going to discuss the gold and silver, what is known as the high quality store of value. I've been wanting to get into this because of what is known as the fragile nature of currencies. A lot of people don't understand this, and it's not just the assets, but it's also the fragile nature of currencies. And I believe we're going to see future trouble with the digital banking system. You see, the banking system is very fragile, and it's not just the debt and derivatives. It has to do with the technology that runs the banking system. And a lot of people don't understand that the banking system is very fragile. So I'm going to discuss that, but before I get into the fragile nature of currencies, I want to do an update on the overall markets. Now, I've discussed this chart many times, and it's good to do a quick update on it for the new folks who are following my work now and checking out the video. This is the net commercial short positions of silver. And in summary, the red lines are the commercials, which they basically control the price of silver. When you see a very large number or a large line, that means a peak in the silver price. When it sells off, and the numbers fall, this is a low in the silver price. These are the days here. It's weeks, and we see a cycle. Now, over the past several years and decades, the low for the commercials has been about 20,000. I've even seen 15. Now, 3 weeks ago, I showed it got to a low of 3,200. And then 2 weeks ago, we saw the markets really sell off again. Gold and silver prices shot up, and the commercials added, but not much. But look what's happened this last week when the markets turned around and gold and silver sold off again. The net commercial short position for silver is at an all-time low of 2,600. Now, if we compare that to gold, we could see that gold during it 2 weeks ago, when it shot up nearly $50 up to $13.50, there's a huge increase in the commercial net short positions in gold. It was up to 226,000. But then last week, when the gold price sold off, we saw a liquidation. Even at 189,000 contracts, which is the new number for last week, it's still above its 75,000 low. So silver, when you see silver, the commercials this low, that means that they're thinking that the price is not going to continue to fall much from here. And now, one last thing, the large specs, which are in blue, they're now short, and they've been long. So we're seeing a very interesting setup. Now, oil is much different than gold, especially silver. Where silver is hitting a bottom, oil is still looking to top out. And when the markets peaked at the end of January, the Dow Jones and S&P, so did the oil price. I think it hit $66. So we had a huge increase in the commercial net short positions of oil. But as the markets sold off and then recovered, sold off and recovered, we see this up and down movement. Same thing in the S&P as well as the Dow Jones. Now, when we start really seeing the market sell off, when the Dow Jones falls below 23,000, goes down to 22,000, then we're going to see the oil price fall with it. Now, I've shown this chart, but it's a bit different. It's by the advisor perspectives. They do an excellent job using their charts. It used to be the NYSE margin debt compared to the S&P 500. Unfortunately, the New York Stock Exchange is no longer publishing the margin debt figures. They stopped as of the beginning of 2018. Now, FINRA, the financial organization, they continue to publish these figures, but they include the NYSE as well as some other small exchanges. For example, at the peak in the end of 2017, the NYSE margin debt was $600 billion. Here, total margin debt what FINRA has is 660 billion. Now, as I mentioned before, I'll quickly summarize again. As the margin debt increased, so did the S&P. It fell off, and we see the same thing. Now, what's interesting, the gray areas here are recessions. Now, when the margin debt peaked, it took about a year, and in this case, about 6 months before the recession hit. Now, we're not really in a recession according to the mainstream media. And is this the peak? We won't know. But this next chart, what they did is they took the margin debt and they inverted it. The S&P is still the same, but the margin debt has been reversed. So when the margin debt peaks, that's when we see the exact opposite for the S&P. So when the margin debt falls, because this is zero, this is 700 billion, when it falls, so does the S&P. Now, look where we're at now. We're at about 2,600 for the S&P. Look where the margin debt is. It's way down here. Now, there is an analyst, which was published on Zero Hedge this week, Albert Edwards. And he says in the next recession, the S&P will drop below 666. That's 666. They call it the mark of the beast. There's Albert Edwards. Now, when the S&P got to a low in 2009, it fell to about 800 points. It's at 2,600. He sees it going down to here. Now, with this kind of margin debt, it's very likely. Now, what's interesting about Albert Edwards, and he's showing the Fed tightening usually ends with a financial event, and we're starting to see a tightening now. So what does Albert Edwards say one should buy ahead of the next ice age? If the US 10-year Treasury goes from 3% to a -1, that's a huge return. But if you're in equities, it would be either Japan, or if you can invest only in the US, Edwards says then gold miners, as gold will exceed its previous $1,900 per ounce high, and as well as the silver miners. But I agree with Albert on that call. Now, if we look at another indicator, which is the trade deficit, if we take out petroleum, and now the United States is exporting more petroleum, if we X that out and remove that, the trade deficit is now at monthly 50 billion. And at the peak in 2006, it was about 43 billion. So we're seeing that our trade deficit now is getting back to a new low. Another bubble indicator is the median home price in San Francisco. Yes, this is a very hot market. All markets in the United States aren't behaving this way. However, they're like in Texas, Houston, and Dallas, they're going crazy as well. But as we can see, according to Paragon Real Estate Group, who put this chart together, and this is sales reported by the MLS beginning of April, just a week or so ago. The median home sales price for San Francisco is 1.6 million. And that's quite fascinating. But just 6 years ago, at the beginning of 2012, it was 665,000. So in just 6 years, it's almost $1 million more. Now, if that's not a bubble territory, and if we look at the data for the US as the average median home price, it is 30% higher than what it was in 2007. So again, the real estate markets are in bubble territory. We're starting to see leverage, margin, and debt in bubble territory. Now, before I get into the fragile nature of currencies, I have got to discuss the energy, because what people don't understand, the energy runs everything. And so one of the notions that is put forth by the media is that we're going to have solar and wind is going to be the solution to our energy problems with oil, natural gas, and coal. Now, to do that, we have to have an exponential increase in PV installations. And we've seen a nice increase. It's been about 20 to 40% annual increases. And then we had a huge jump in 2016. This is about a little more than 15,000 megawatts of new solar. But in 2017, it fell 30%. Now, but here's what's interesting for 2018, according to the EIA, they're only going to add about 11,000 megawatts. This isn't much. This is only about a 3 to 4% increase compared to compared to 20 to 40% here. So this is slowing down. Now, there's a reason for that. This shows what is going to be the new electric generating plants proposed for this year up until January 2019. And I've mentioned this in my recent article, but unfortunately, a lot of my followers, precious metal followers, didn't read the article. So I've got to put it in here because if you don't understand the energy, you won't understand the reason why it's important to hold the precious metals. Now, as you can see, there's a lot of red dots, and that means it shows the circle area proportion to the megawatts. The larger the circle, the more megawatts a facility. Natural gas are the larger number, wind is in green, and the solar is in yellow. So if we look at the total number, proposed U.S. electric generating plants that are going to be added this year, it's 65,000 megawatts of natural gas, 21,000 of wind, and 11,000 megawatts of solar. So even though there's this notion that we're going to add all this wind and solar to offset our energy, natural gas, coal, and oil, we're still doing 2 times as much natural gas than we are wind and solar. And solar is starting to not increase as much as it did before. Now, the reason why we're getting so much natural gas has to do with the price. The price is so cheap. And these are the largest natural gas producers in the United States. Now, this a new merger, before the merger last year, the end of last year, ExxonMobil was the #1 natural gas producer in the US, followed by Chesapeake. But since EQT and Rice Energy merged at the end of last year, they are now the largest natural gas producer. Well, being the largest natural gas producer, you would think that they're making a lot of money. In my article, I presented these 2 tables. We've got Chesapeake, which is the 3rd largest natural gas producer, shale gas in the US. And here we've got EQT Energy, Capital Energy. Both of these charts show their free cash flow and their capital expenditures. Now, free cash flow, to me, is the most important indicator that shows you if the company is doing well. And as we can see, the 3rd largest shale gas producer hasn't made any positive free cash flow since 2003. I call it a sea of red. They lost $1.7 billion. What that means, they spent $1.7 billion more in capital expenditures to produce the shale gas than they made from their operations. Now, EQT Rice Energy is now the largest. Now, they're not quite a sea of red because they had 1 year, they made $215 million in positive free cash flow. Again, free cash flow comes from taking their cash from operations and deducting their capital expenditures. But as we can see, it's also been red. And they merged last year and they still lost $1.1 billion, or they spent $1.1 billion more than they made. Now, if the natural gas companies aren't making money, then the shale oil companies aren't making money. So we have trouble with shale oil and we have trouble with shale gas. We also are seeing trouble with the major oil companies. And these are 8 of the largest global oil companies. And in 2013, they were paying $5.7 billion of an interest expense a year. This is combined. Well, 4 years later, now it's tripled. They're paying $15.4 billion of an interest expense. So the $10 billion that these companies are are making in profits can no longer go to capital expenditures or shareholders. They have to pay this just to service the interest on their debt. So we're starting to see a lot of trouble with energy. We're starting not to see only in shale oil and gas, but it's as well as the major oil companies. Now, the reason why that's important has to do with the fragile nature of currencies or the lifespans of different forms of currency. As I've said before, energy drives the economy. Energy allows technology to be developed and used in our economy. And looking at the top 4 currencies, I found that the average life expectancy of a gold coin is 35 years. Now, what I mean by that is the face. If this gold coin is used in public, it's going to wear off its face. So what happens, the gold coin needs to be taken back in by the government, reminted, and a new gold coin is then put in the public use. However, most of the gold is there. I mean, 99% or more of the gold is there. Just a little bit gets worn off. So this gold coin could continue to work for literally hundreds of years if it's not lost. Now, the next thing are paper money, Federal Reserve notes. And I took the average of the 1, 5, 10, 20, 50, and $100 bill. If you average them together, the average life expectancy of a Federal Reserve note is 8 years. Now, what's fascinating, which most people don't realize, and we use it all the time, is the digital banking system. This is using debit cards to purchase things, using credit cards, using wire transfers, using checks, using the banking system, mortgages, whatever. The digital banking servers that run the banking system last on average 4 years. Now, we take it one step further with the new cryptocurrency mania. The Bitcoin miners that produce the Bitcoins, as well as transactions, these miners are lasting between 450 and 2 years, 450 days and 2 years long that have to be replaced. So what we see, the more high-tech the currency, the weaker and more fragile it is. The lower tech, it's more strong and durable. And you could see a big drop off to Federal Reserve notes, falls in half to digital banking servers, and then it falls in half again to the crypto miners. Now, this is a infographic by Sims Recycling Solutions, and it's a pretty good infographic. It's about the life cycle of a server. Now, servers run everything today in our system: the internet, the transportation system, the banking system, the financial system. It runs basically it runs everything. Now, they said data centers are big. The world's largest data centers occupy 1 million square feet. That's 17 football fields, and they're only getting bigger. 5.75 million new servers are installed each year. We can see that increase here. Now, higher demands, newer technology, we are seeing shorter life cycles. Now here, the average server replacement cycle is 3 years. Now, according to my chart, I went with 4. I saw indicators of between 4 and 5 years, but I put 4 years. This infographic is saying 3. Now, there's this idea that the banking system could use cloud, right? We could use cloud service, the cloud software. But the cloud-based servers also need servers. But a lot of these institutions don't trust the cloud, so they have a local backup. Regardless, our high-tech economy is run by the server. It's managed by the server, and these servers need to be replaced on a very short period of time, 3 to 4 years. And that is the reason why it is very important for precious metal investors to understand the energy. Please watch my energy videos, read my energy articles, because high tech is going to come under a lot of trouble because of energy. And the more high tech it is, the weaker and more fragile it is. The lower tech, the more strong and durable. So this is where we're going to go back to. People don't think, they think technology is going to solve all our troubles. They're not. This is where we're going back to. During crisis, it's probably smart to have dollars, to hold on to dollars, as well as precious metals. Now, in these last few charts, I wanted to show you the gold-silver ratio, because over the past almost 40 years, the gold-silver ratio has been trending between a high of about 81 and a 47. And it's been, the average is somewhere in the 60 to 62 range. Now, with the net commercial short positions in silver at a record low, and the gold and silver ratio at a record high, as well as the markets, the margin debt, the Dow Jones, everything is at an extreme. When the markets roll over, we're going to see the gold-silver ratio head much lower. And again, it's important that people understand the fragile nature of currencies. I want to go back to that chart one more time. People need to understand this. I'm not talking about assets, which are stocks, bonds, and real estate. I have been talking about that. I'll get into that in just 1 minute. But one of the most important aspects of a currency is its durable and strong nature. And we don't have, our system is being run by digital banking servers, as well as now the crypto is these Bitcoin miners, the Ethereum miners. This is not long-term sustainable. This is. Now, my last chart is the global mainstream asset universe. And I just wanted to show this chart because this is where 99% of the market is invested. 228 trillion. This was as of April 2017, or 228 trillion in real estate, over 100 trillion in securitized debt. That's bonds, government bonds, etc. And then we have the global equity stock market. And it's less than the bond market. It's 70 trillion. And right here is the value of all the investment gold and silver we can get our hands on. If we add up all this, it's about 400 trillion. Now, it is leveraged, but if just a fraction of that money started moving into gold and silver, we could see very silly prices. Now, I wanted to conclude because when I did the research on the fragile natures of currency, I had no idea. Matter of fact, I was naive. I just took for granted that the digital banking system that runs everything was going to be around forever. But, you know, it's not as fragile as the crypto market, but it's extremely fragile. And when energy becomes problematic, I see a lot of trouble. I see future trouble with the digital banking system, which is why it's going to be very smart to be owning actual dollar bills, as well as owning gold and silver. Now, I thank you for joining me on this newest video. I'll be putting out another video next week. And I also wanted to ask, if you haven't yet subscribed to the SRS Rock Report YouTube channel, please do. You'll get anytime I put a new video out. It sometimes takes a day or so. And also, I mentioned this at the end of every one of my articles. I really appreciate the support from my PayPal as well as Patreon members. And again, this is an open website. I put this information out for the public. and I appreciate the support I get from my PayPal and Patreon support members. And if you'd like to, please consider donating and supporting the SRS Rock Report website if you think this information is very interesting. Thank you very much.